Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. So since the last episode, it feels like there's been a little bit of a capitulation in markets, and that's not from the bullish people out there, but perhaps the bearish people, those betting that the market would fall. Because if you recall last week, we were around about the sort of 2,800 level on the S&P 500. And the markets had rallied and then sort of got stuck just below that key threshold and the sort of 50-day moving average, which is a key level a lot of traders keep an eye on. And so the market was stuck below a level where it needed to break through if it was going to try and push higher towards or have any chance of getting towards those all-time highs that we saw back in February. Now, there are a number of things that we were looking at that were holding the market back. The VIX, the VIX, which is a measure of volatility on the S&P 500, that's effectively what it's reflecting. That was still elevated, and we were up about 42. The long-term average is near at 20, and that's where we'd like to be if it was going to be a signal that this rally was something more than just a bear market rally or dead cat bounce, as some would call it. In the last week, the VIX has fallen to 33, and I think as I make this video, it's now around about 31. So we've seen a significant drop, but we're not right down near that 200-day moving average of the VIX or the sort of historical average. But there has been improvement. Equally, there's been a improvement in breadth on the S&P 500, and we've seen that reflected in a lot of stock markets around the world. We're not at a point where the majority of stocks are above their 200-day moving averages. That 200-day moving average is a line which a lot of traders look at because being above that is seen as being fundamentally bullish, being below that is seen as being fundamentally bearish. So some pay more attention to it than others. But of course, if more stocks are above it, that's got to be a good thing. If more are below it than are actually above it, then that's obviously a bad sign. And we started to see the number or the percentage of stocks within certain indices that are above their 200-day moving average creep up. It's still at a slightly distressed level, but it's hinting that perhaps the market is getting to a point where this rally could be sustainable. So that's why we're getting a bit of excitement from people who are very bullish on the market, and also why we're getting some capitulation from those people who had been short in the market. After all, with the market rallying over 20-25% in some cases in just over a month, from the lows we saw at the end of March, people who've been trying to bet that the market would fall are probably running out of money at this point. So the S&P 500 has bounced, as I'm looking at it now, up to 2940. You wouldn't have actually thought that was likely a month ago, given the implosion of the economy, the problems we've got with the coronavirus. They've not been solved. We've had millions of people become unemployed, particularly in America, where we saw unemployment reach a point where it wiped out all the jobs that had been created since the financial crisis. And we have even seen the FTSE 100 bounce back above 6,000, which again is probably unexpected by some people. Now, what we've also seen are tech stocks continuing to fly. So when people are staying at home, there are a lot of technology solutions that are being used. So Amazon for shopping. We're talking about Microsoft for its cloud capacity. We're also talking about Facebook, which is another tech stock, which is seeing an increase in usage. Netflix. But what's happened? These growth stocks have become very dominant in the influence on the returns of the S&P 500, for example, and it's a very crowded trade. So there is a point where their valuations are extremely stretched and, if anything, look a bit frothy, but people continue to pile into them. But what it's meant is the breadth of the rally has narrowed, so we've become ever more reliant on these tech stocks. So going into this week, it was always going to be key what happened when those companies announced their earnings results for the first quarter of this year and what impact the coronavirus has had on their earnings and perhaps their outlook. Well, we overcame that hurdle because the earnings results for most of these tech companies were greeted with huge optimism and cheer by traders. In fact, we saw the stock price of Facebook rally up to 10% in after hours once they'd released their results, we saw a similar thing with Google. Alphabet is the parent company, as the advertising revenues were hit but seemed to stabilize in the month of April. So it means that people are even more inclined to invest in these tech stocks, these large caps, and it means that they've helped push the wider indices higher. If you strip them out of the indices, interestingly, then the performance of the index since the sell-off hasn't been as impressive because there hasn't been as much of a bounce back because of that influence those large stocks have. But of course, tech stocks have been doing well. Oil has rebounded. Last week, I explained about the price of oil. We've seen the price of oil for the next contract in June initially plummet, but then start to recover. Now, the market has obviously been slightly buoyed by that. It's taken that as a positive. We had the Federal Reserve announce another policy decision, which was to do nothing, but the sound bites that came out of the press conference afterwards suggested that the Fed is going to keep its easy monetary policy for as long as it takes and isn't really caring too much about the debt bubble that it's creating. It even expanded the types of bonds that it would buy as part of its quantitative easing process. So this has all been in the mix, has caused stock markets to rocket. And we suddenly saw a spike in the last couple of days of April. And part of that was also driven by some good news surrounding Gilead. And Gilead Sciences is a company that's trying to develop or is doing trials on a drug that's meant to help improve patients' conditions if they are hospitalized with the coronavirus. And initially, about a week or so ago, China put out some information and results, leaked it to suggest that the trials were actually killing people and they were failing. And the World Health Organization published that on their website. It caused their share price of that particular company, Gilead, to tumble. But this week, we've had the company themselves confirm that that was all nonsense. And actually, there's been some positive signs from those initial trials. And the market has become slightly euphoric about the idea that we could have some sort of treatment, not a vaccine, a treatment that could help improve the recovery from the coronavirus and ultimately, therefore, reduce the potential impact on the economy. We're a long way from this becoming a treatment that's going to be universally used. In fact, we'll be months away, but that didn't stop the market getting carried away. So optimism is the word. The market is very optimistic. We've seen, like I say, breadth improve with banking on stocks, tech stocks being able to carry the load until everybody else and other companies are able to recover. And this just added to that optimism. But of course, we're now approaching the point where the market has pushed up through that 2,800 level. It's actually gone over 2,900, and it's very quickly moving back towards the 3,000 level, this is the S&P 500. And the reason that's quite key is because that's the 200-day moving average for the entire index. If we push above there, then it does make the likelihood of a retest of the highs from February much more likely. But of course, you have to sit there and think there is something that's got to give somewhere, because at the same time we're having the stock market rally, bonds are doing very well still, particularly if you're invested in things like US treasuries or government bonds or gilts, for example. Gold is doing very well. The US dollar is doing very well still. These are all haven assets that should be underperforming if everything's great. And of course, the economic numbers we keep getting out are some of the most disastrous we've seen, certainly since the financial crisis and going back decades. So with them all rallying at once, haven assets and the stock market, it's happened before, but usually one of them will start to give. And which is it going to be as we move into May is the big question. And we've also seen another divergence. We've seen US stock markets. If we look at them and you look at the highs from February, we're down around about 13% now. So it's come out of that 20% level, which marks a bear market. So it's back down only about 13% from its recent high. Whereas if you look at the rest of the world, the UK, for example, the FTSE 100, European stocks, we're still down over 20%. So there's been this divergence, this fear of missing out has really caught hold of the US stock market, but not so much the rest of the world. So the message is, if you'd been invested in US stocks, if you particularly tech stocks, and therefore benefited from the currency trade, so the dollar rallying and the pound therefore falling by comparison, that would have insulated your portfolio. So any funds you see out there that have held up well over the last 2 or 3 months are likely to be focused on those areas. But of course, that does make them vulnerable for a reversal of that trade if suddenly everybody capitulates and realizes that perhaps the tech stocks aren't the safe haven as they're being perceived to be, that everybody thinks that they are. So as we head into April, people will be looking at the markets and think they don't make a lot of sense. And I can fully understand that, but they don't have to. And with people who are betting on the market falling now capitulating, it's helping to drive the market higher. We will have to see what May brings us. Is May going to be the month where the market does suddenly catch up with reality, the stock market I'm talking about, or will it indeed push higher and have been shown to be front running a recovery or a faster recovery in the economy? So the message is markets are certainly at a point that's very critical and are definitely trying to push higher. We're going to find out which way they're going to go. And if they break down, for example, if you look at the S&P 500 below 2750, then it could open the door to something much lower. But the market right now is full of optimism. Whether that is rightly or wrongly, we'll find out whether that's complacency, because it very much looks like how the market looked at the start of February. So that is it for this week on Damien's Midweek Market. As ever, you can contact me via Twitter, money to the masses with the number 2. You can also contact me on Facebook. Don't forget to join our Facebook group. It's facebook.com/groups/money to the masses. And of course, you can follow us on Instagram and subscribe to our YouTube channel.